Welcome to the deep dive. Today, we are jumping right into what is really a high-stakes financial drama unfolding in the Nordic industrial sector.
That's right.
And it's all centered on a company called ALLIGO-AB. This isn't just about, the normal ups and downs of an economic cycle.
Yeah, not at all.
It's about strategy, it's about debt, and it's really about the chaos that gets created when you merge two huge companies and then right after try to execute this aggressive growth plan during a severe downturn.
It's a perfect storm, really. The sources you shared give us this fascinating, almost granular look at a company caught in a perfect vice. Alligo is the result of a major multi-year integration.
Right, that was the Momentum Group offer for Swedel back in 2019.
Exactly, and that was all designed to create this single dominant Nordic platform. But what's happened is they've been stress tested, really stress tested, immediately after this huge integration phase.
And tested by what? By their own strategy.
By their own aggressive acquisition spree, yeah.
Yeah.
All while the broader economy just moved into a deep cyclical trough.
So our mission today is to unpack this entire story. We're going to look at their structure, the pretty intense financial stress they're under, and the really dramatic leadership pivot that's happening right now.
And for anyone who isn't familiar with them, Alligo is a major distributor in the B2B space.
What are they selling?
They're supplying industrial consumables, workwear, PPC, personal protective equipment, and tools. It's the nuts and bolts of industry.
And they operate across the entire Nordic region, which is a massive market. We're talking something like, 59 to 60 billion Swedish kroner annually?
A huge market, and because of that, their health, or lack thereof, tells us volumes about the health of Nordic industry, construction, infrastructure spending, you name it.
So I guess the central question we have to analyze is whether that foundation they built, that huge, scalable, integrated platform, is it sturdy enough to weather this storm?
Or is it actually the source of their current financial pain? And to do that, I think we first have to really get our heads around the unique dual structure they operate under.
Okay, let's unpack this then. Let's start with Alligo's engine room. Section 1, their dual business model and integrated platform. Alligo's structure, as you mentioned, is really a duality. And I think that's the key to understanding all the complexity here. The majority of the business, something like 80% of their total sales, falls under what they call the integrated concept brands.
Right. This is the core engine. It's designed purely for efficiency and scale.
This is the behemoth that was created by that merger.
This is the behemoth. You've got Swedel, which is the main brand in Sweden, and then you have Tools, which handles Norway and Finland. And the whole idea here, the entire philosophy, is standardization.
Everything the same.
Everything. They run it all off a shared Nordic logistics operation, a single IT platform, and a broad standardized product assortment. The strategic goal of this 80% of the company is just operational excellence. It's about capturing massive synergies from scale. It's supposed to be impenetrable.
But then, and this is where it gets interesting, they have this rapidly growing counterpoint, the non-integrated businesses.
Yeah, and this is where the strategy shifts completely. It's a 180-degree turn. Instead of absorbing new companies, they buy into the existing structure.
The old playbook.
The old playbook, yeah. They now acquire these specialist companies and deliberately allow them to run independently.
It's a fascinating strategic split, isn't it? And it feels like a huge insight into where they think their future direction lies.
It is. They're trying to build strong positions in these highly profitable niche areas, what they call technology areas. And to do that, they're consciously forfeiting the initial synergy benefits you'd get from folding them into Swedel or Tools.
Why? Why give up those synergies?
To preserve the specialist brand value and, maybe more importantly, the expertise. You buy a niche battery company, the last thing you want to do is break up the team and the culture that made it successful in the first place.
Can you give us a few examples of these key verticals they're targeting?
Absolutely. The sources really highlight the recent moves. They are going heavily into batteries.
Right. The Svenska Batterilagrid deal?
That was a significant acquisition in early 2025, a business doing about 275 million kroner in revenue. Then there's welding with the Carema Svets acquisition late last year. And finally, they're doing a strategic roll-up of multiple smaller companies in what's called product media. It's basically corporate profiling and branded goods.
So what we have is this fundamental tension inside one company. You've got this massive 80% core business, totally focused on standardized scale and efficiency. And then you have this rapidly expanding 20% that is dedicated to preserving niche specialization. I mean, the difficulty of managing those two conflicting mandates, it can't be overstated.
It's like they're trying to run a hyper-efficient marathon runner and a specialized sprinter team at the same time with the same coaching staff.
Exactly. So let's talk about that core business, the concept brands. They've built up what looks like a pretty impressive market defense, their moat.
They have, and they've really engineered their sales channels, their whole omni-channel strategy, specifically to serve the high-margin, small and medium-sized enterprise customer, the SME, and to achieve maximum stickiness with them.
Let's break that down, that stickiness. How do they do it through those four channels? The foundation, it seems, is the physical footprint. They've got a dense network of, what, around 239 physical stores across the Nordics? Why are these stores still so crucial in a digital age?
Because in B2B industrial supply, immediacy is everything. I mean, think about it. If a contractor or a small manufacturer needs a specific tool or a piece of PPE right now to avoid halting their entire operation.
They're losing money every minute they wait.
Exactly. They go to the store. And these physical locations, they generate the majority of Alligo's revenue. And critically, they cater to those SME customers who will happily accept higher margins in exchange for speed and availability.
That network, then, is a huge moat.
It's a massive moat. It's extremely capital intensive for any new competitor to just show up and replicate 239 locations and, all the local relationships that go with them.
I think so. That's the SMEs.
Yeah.
But they also have to cater to the big volume buyers.
Yeah.
And that's where the second channel, field sales and telesales, comes in.
Exactly. This is your traditional direct sales force. They're focused on serving the large corporate clients, the public sector accounts. These sales make up a significant chunk of revenue, around 42% of the concept brand sales.
But the margins are different.
Very different. These are high-volume, predictable sales, sure, but they are typically executed under long-term contracts at much, much lower margins than the SME walk-in traffic.
And the third channel, digital, feels almost like table stakes now. E-commerce,
Yes,
customized procurement solutions.
it is. It's necessary, but it's maybe less of a differentiator. The true brilliance of their defense, I think, lies in that fourth category, on-site services.
This is the high switching cost factor you mentioned.
This is it. This is Alligo embedding itself so deeply into the customer's operations that replacing them becomes prohibitively painful and expensive.
Okay, so what are some specific examples of these sticky services?
The sources point to smart services. So think of this as advanced on-site inventory management. We're talking about vending machines placed directly inside the customer's factory.
Dispensing tools and supplies.
Right. And Alligo manages the restocking, the inventory levels, the data. Once that vending machine is installed and it's integrated into the customer's procurement system, the cost and the sheer effort of switching to a new supplier just explodes.
And then there's the new offering, Recare. What's that about?
Recare is a perfect example of a value-add service. It launched in 2025, and it's a full-service workwear solution. So you don't just buy the work clothes from them.
You subscribe to them.
You basically subscribe to a full life cycle service that includes laundry, repair, replacement, and eventually recycling. It transforms a simple product purchase into a long-term, high-involvement service contract.
And once you've outsourced the entire management of your employee workwear to Alligo, you are tied to them, aren't you?
You are. A slight price difference from a competitor becomes almost irrelevant when you consider the hassle of ripping all that out and starting over.
So now that we understand the channels in the moat, let's zoom out to the competitive landscape. Alligo's focus is 100% on the Nordics, but as the sources show, their profitability isn't evenly distributed at all.
No, it's heavily, heavily weighted toward their largest market. Sweden contributes a commanding 56% of their total EBITDA.
And we should probably clarify, EBITDA is earnings before interest, taxes, and amortization. It's the best measure we have for their core operating profit, and we'll be using it a lot.
Definitely. After Sweden, Norway is next at 27%, and Finland brings up the rear with 17%.
Now, you'd think in a fragmented market they'd have an easier time, but they operate in a really tough competitive environment.
They do. They generally rank number 2 or number 3 in their core categories. For example, in Sweden, they are number 2 in tools and supplies with about a 20% market share. They're a big player, for sure, but they are not the giant.
So who are the giants? Who dictates the M&A pace and really applies the competitive pressure?
There are 2 massive competitors to watch. First is Ahlsell.
The CVC-backed one.
Exactly, backed by CVC Capital Partners, which means it has enormous private equity firepower and a super aggressive acquisition strategy. And then there's the German private giant, Wirth, which is globally huge and deeply, deeply entrenched in the market.
So Alligo is constantly up against these behemoths.
Constantly. These players are bigger, they have deeper pockets, and they often set the benchmark for efficiency and scale. It makes Alligo's own M&A strategy absolutely crucial, not just for growth, but for survival and market share defense.
So if the competition is that fierce, let's just summarize. What are the three definitive competitive advantages, the moats, that protect Alligo?
Okay, number one is the sheer scale and that centralized logistics and IT platform. This is the big promise of the merger operational leverage and purchasing power that smaller regional players simply can't match.
Number two would be that omni-channel network.
That comprehensive omnichannel network, yeah. The hard-to-replicate combination of 239 stores, a digital presence, and a direct sales force.
And the third, which you flagged as critical for protecting their margins, is own brands.
Absolutely essential. They own brands like Gesto, Bjornkleider, and Univern. Now, these account for less than 20% of their sales, but they are crucial because they significantly boost profitability.
How so?
Well, when you sell a generic hammer, you're a commodity. Anyone can sell that. But when you sell a Bjornkleider work jacket, you control the design, you control the supply chain, and most importantly, you control the margin. Own brands are their primary defense against market commoditization.
So, okay, we have a company built on a high, fixed-cost, integrated platform protected by sticky services and proprietary brands. That all sounds great in theory.
In theory.
But to really understand the drama that's unfolding now, we need to transition into Section 2 and see how this very powerful engine handled the inevitable economic turn.
And that raises the most important question, right? How did this highly scaled, high fixed cost structure actually fare when the Nordic industrial and construction economy just slammed on the brakes? And the answer really lies in the harsh reality of cyclicality.
The sources make it crystal clear. Alligo is highly cyclical. Its fate is just tightly correlated with macroeconomic conditions. So as central banks all over hiked interest rates and construction projects stalled across the Nordics, Alligo felt that pain immediately.
Let's start with the top line, with revenue. If you just look at the overall 2024 revenue figures, 9,333 million kroner, it looks flat compared to the year before. But that number is deeply misleading.
Why? What was it hiding?
It was masking a critical internal deterioration.
That flat revenue figure, then, was created by a massive divergence in how they got there. The core business, the integrated platform, it experienced a collapse in organic growth.
A complete collapse. It accelerated to a negative 3.9% in 2024.
Wow. So that means their existing customers were simply buying less quarter after quarter.
Precisely. And if you're wondering how revenue stayed flat despite this nearly 4% contraction, the answer is M&A. Acquisitive growth accounted for approximately positive 3.9% of growth.
So they perfectly offset each other.
They did. And this is the crucial takeaway from that period. M&A was no longer about expansion and upside. It became essential just to fill the hole that was being left by their shrinking core business.
It's like running on a treadmill. They had to go out and acquire roughly 360 million kroner worth of new revenue just to stand still.
That's a perfect way to put it. It means their core strategy, the whole point of the integration and efficiency, was completely overshadowed by the need to just bolt on new companies to maintain the illusion of stability.
And that 3.9% decline in organic volume, that immediately exposed the fundamental liability of their structure, didn't it?
It did. The centralized, high-cost platform, which was built for scale, now suffered from what's called negative operating leverage.
Okay, for those less familiar with the jargon, what exactly does negative operating leverage mean in practical terms for a company like Alligo?
Okay, think of Alligo as running a very large integrated factory or maybe a chain of restaurants. You have fixed costs that do not change whether you sell one tool or a million tools.
Right. The rent on those 239 stores, the staffing of the logistics centers, the maintenance of the IT system.
All of that. Those costs are fixed. So when your volume, your organic sales is high, those fixed costs are spread very thinly across many sales, which leads to high profitability. But when your volumes drop by nearly 4%,
those same costs are now spread across a much smaller revenue base.
Exactly. The store is still open, the lights are still on, the salaries are still being paid, but 4% fewer products are moving through that system. The cost structure is, in a sense, geared too high to handle a volume drop.
And the result is a massive decline in efficiency.
A massive decline. And this pain cascaded directly to their profitability, causing a severe margin collapse.
We could see this really clearly in their adjusted EBITDA margin. It plummeted from a very healthy peak in 2023 of 8.9%.
All the way down to a trough in 2024 of just 6.4%.
That's a 250 basis point drop. I mean, that shows just how unforgiving this high fixed cost base is when the cycle turns against you.
Now, here's a critical detail that really needs to be appreciated. Their gross margin, the profit they make on the products themselves, remained incredibly resilient. It was hovering around 40.7% in 2024.
Which is a point of strength.
A huge point of strength. It means they maintain their pricing power, thanks in part to those own brands we talked about and that customer stickiness. They weren't fighting a price war.
So the problem wasn't pricing.
No, they were fighting a cost battle, and it was a battle driven purely by reduced volume. This confirms the entire margin collapse was an operating leverage problem, not a pricing problem.
And of course, that margin collapse immediately hits the balance sheet because it shrinks their profitability, which is the denominator in their most important financial safety measure.
It is. ALLIGO has a very clear financial target. Net operational liabilities to adjusted EBITDA must remain below 3.0x.
Okay, let's define EBITDA quickly. It's earnings before interest, taxes, depreciation, and amortization. It's basically the closest measure we have to the raw cash flow generated by the business operations.
And it's the key metric that lenders use to see if a company can actually service its debt.
So as that EBITDA number shrank dramatically because of the margin collapse, and at the same time management continued to take on debt to fund all this aggressive M&A.
The leverage ratio just spiked, and critically, as of the Q3 2025 report, it officially breached the target. It reached 3.1x.
Now, a 0.1x breach might sound small to some listeners, but for a leveraged company like this, hitting or, exceeding a stated financial target is a huge red flashing light.
It's a very big deal.
Why is that breach so material? What are the practical implications?
Well, first, it signals material financial risk to the entire lending community. It means higher borrowing costs in the future, and it severely, severely limits their capacity for any future debt-funded M&A.
Right. And it can lead to technical covenant violations in their loan agreements.
It can, which gives the lenders a lot of leverage in negotiations. And third, and maybe most visibly for investors, it imposes immediate discipline on capital allocation, specifically on dividend payments, as the priority shifts entirely to deleveraging. It puts immense pressure directly on the controlling shareholder, Nordstjernen, to act.
So they're trapped. They need the M&A to maintain their revenue, but the M&A increases their debt, which stresses the balance sheet, which then limits their capacity for future M&A.
It is a vicious cycle, and it's all being driven by the macro downturn.
And to make matters even more confusing, we have to talk about what the sources call the cash flow illusion of 2024. If you just look at the headlines, cash flow from operations was an amazing 952 million kroner. That's more than triple their net income of 279 million. This looks like fantastic cash generation, completely decoupled from their weak profit.
And this is exactly why a deep dive is so essential, because that figure is entirely misleading. It was not profit-driven cash flow. We have to perform a quality check on the source of that cash.
And where did it come from?
It was generated by a massive one-time working capital release.
What does that mean in simple terms?
It means that management did an excellent job of intensely reducing their inventory levels. So think of ALLIGO as a retailer with a huge warehouse full of tools and supplies. In 2024, they sold off a lot of that existing stock without immediately replenishing it at the same rate.
So they liquidated inventory.
They liquidated inventory to generate short-term cash flow.
So if you're strapped for cash at home, it's kind of like selling your expensive furniture to pay the rent. It works once.
But you can't make a sustainable business model out of selling off your assets. That's the perfect analogy.
Because that source of cash is finite.
It's completely finite. Once your inventory hits a sustainable, lower operational level, the party is over. The moment they need to actually restock their warehouses to keep those 239 stores supplied, that cash flow reverses.
And we have the proof that the illusion ended.
We saw the immediate and brutal normalization in the Q1 2025 report. Cash flow for operations didn't just normalize, it turned sharply negative, hitting minus 38 million kroner.
Wow.
And this proved that the underlying cash generation capacity of the business is tied directly to that low underlying profit level. The massive 2024 cash flow was a one-off anomaly driven by asset liquidation, not sustainable earnings.
So the core takeaway from this entire financial stress test is that the integrated platform created a high fixed cost trap. The downturn triggered that negative operating leverage,
which then pushed their debt ratios past their safety limits, forcing this sudden and unsustainable cash generation strategy. It is an extremely precarious moment for the company.
So given this extreme financial pressure, how did management respond? Here's where it gets really interesting.
They doubled down.
They doubled down on the very thing that was driving their debt increase M&A.
Well, did they have a choice? As we established, M&A became the necessary tool to offset that continuous organic decline. Even as recently as Q3 2025, organic growth was still negative. It was down 2.7%.
You can't let your top line visibly collapse, can you? Especially when you're trying to manage high fixed costs and a very stressed balance sheet.
Exactly. So we saw this flurry of key recent deals, most notably in those non-integrated specialist areas we talked about.
Their focus was laser sharp on that niche technology.
Laser sharp. The deals included the Svenska Batterilagret and Karima Svets, plus that continued roll-up of product media businesses like Respond Profilering and Galaxy Furitex Reklam. The message from management is clear. When the core slows down, you accelerate the periphery to maintain overall momentum.
But this acceleration came with a major strategic pivot in how they integrate these new companies.
Yeah.
Historically, the playbook was the integrated model.
Right. Absorb, realize synergy, and fold it into Sweetle or tools.
But these new large acquisitions are being kept as non-integrated standalone businesses. This is a massive change in strategy.
It is the defining strategic decision of this era for Alligo. They are fundamentally changing their identity as a company. They are consciously choosing to move away from being a singular, synergy-driven, integrated operator toward a much more complex holding company model.
What are the deep practical implications of trying to manage those two contrasting visions under one roof?
I think the implications are profound and they're very complex. The integrated core, that 80% of the business, it demands standardization, it demands centralized IT investment and bulk purchasing. It's focused entirely on cost efficiency.
While the non-integrated specialists, the other 20%, demand the exact opposite.
The exact opposite. They demand autonomy, their own niche systems, freedom to cater to specific technical customer needs. They're focused on specialist expertise and speed.
This sounds like an internal conflict just waiting to happen. How do you decide which business unit gets a limited capital investment?
And that's the holding company risk. You introduce competition for capital, you risk what's called channel conflict. Will a customer buy a welding product from the specialist Karima Svets brand or from the generalized tool store down the road?
It seems counterintuitive. If the integrated platform is supposed to be your big competitive advantage, forfeiting synergy by keeping these new businesses separate feels wrong.
It does, unless you believe the specialist brands are so uniquely profitable on their own that the synergy loss is justified. But this new model, it definitely increases internal complexity and the governance burden at the exact moment they need ruthless efficiency to deleverage.
But amidst all this complexity and stress, we finally did see a sliver of good news. The sources call it the green shoot in the Q3 2025 report, which came out in late October.
Yeah, finally. After 6 grueling consecutive quarters of declining profitability, the company finally reported an improvement in their core running margin.
What did it get to?
The adjusted EBITDA margin rose to 7.2% in Q3 2025. That's a noticeable improvement from the 6.4% they posted in the same period last year.
So this is the first concrete evidence that either their cost-cutting initiatives are working or that the high fixed cost structure is finally beginning to yield some positive leverage, even if organic sales are still slightly negative.
That's right. Management cited the success of their cost-cutting programs. They've achieved over 100 million kroner in savings, alongside that continued protection of their gross margins.
This provides the bull case for the stock with its first real anchor. But this positive news was immediately followed by a huge dose of leadership uncertainty.
The timing is highly disruptive, to say the least. On October 10th, 2025, just weeks before that positive Q3 report came out, the CEO, Klein Johansson Ullenvik.
He's the leader who oversaw the whole Sweetle Tools integration, the architect of this current strategy.
The very same. He announced his planned departure in 2026. The official narrative, the company line, is that he feels the company building is now complete.
That's a very clean narrative, but the timing is, well, it's suspicious. The CEO is leaving right after the leverage breach and during this pivot to a fundamentally new strategic model.
It creates a significant leadership void and a huge amount of execution risk. I mean, managing a leveraged recovery requires steady hands, and now they're forced into a search for a new leader who has to navigate both the operational scale and the holding company complexity.
Exactly. But to really understand who ultimately drives the strategy here, we have to look at the governance control. This isn't a widely held public company in the traditional sense. It's what you'd call a controlled company. And the mechanism for that control is the share structure.
That's right. ALLIGO uses a dual-class share structure. The Class A shares carry 10 votes each, while the Class B shares carry only 1. And critically, those Class A shares, despite representing only 1.1% of the total capital.
They control 10% of the voting power.
Right. But the true power resides with the dominant shareholder.
And that would be Nordstjernen AB.
Yes, Nordstjernen, the powerful Swedish investment firm, they hold 54.56% of the capital and nearly 50% of the voting rights. Their CEO is listed on ALLIGO's board, which highlights just how hands-on their involvement is.
So this means the investment thesis isn't fundamentally a bet on the operational managers who may come and go.
No, it's a long-term bet on the stewardship, the capital allocation discipline, and the recovery plan of Nordstjernen. They are the ultimate anchor here.
That anchoring influence is crucial, isn't it? If this company were truly independent, a 3.1x leverage breach coupled with a CEO exit would lead to far more market panic than we're seeing.
Absolutely. Nordstjernen provides the essential stability that's needed to execute a very difficult turnaround.
Okay, so we connect this to the bigger picture. The way that Nordstjernen and the current board are authorizing the deployment of cash, that tells us everything about the company's immediate priorities.
It does. Which brings us to capital allocation.
Based on their financial actions, we can clearly outline ALLIGO's implied capital allocation hierarchy. And it seems to be a direct consequence of that 3.1x leverage breach.
It is. Priority 1, without any question, is balance sheet defense and deleveraging. They have to get that 3.1x ratio back below 3.0x. It's non-negotiable.
Priority 2.
Strategic M&A, because as we've discussed, they need that M&A revenue to mask the core decline. Third is organic investment. And then dead last, at the very bottom of the priority list, are shareholder returns via dividends and buybacks.
The most dramatic signal of this hierarchy shift was, of course, the dividend cut. They cut the absolute dividend for 2024 by a stunning 43%.
It went from 3.50 kroner down to 2.00 kroner.
This wasn't a casual decision, was it? It was a forced tactical retreat.
Absolutely. Now, they can technically argue that the new 2 kroner dividend still adheres to their 30 to 50% payout policy.
But only because the denominator, their net income, was so low.
Exactly. But the absolute cut was necessary to conserve cash. Every single krona they save from the dividend is a krona they can use to pay down debt or to fund that crucial M&A engine without taking on new debt, which would just worsen the 3.1x leverage ratio.
And their stance on share repurchases just confirms this, doesn't it?
It does. Repurchases are authorized, but management has explicitly stated that they are a vehicle to pay for future acquisitions and for their own incentive programs, not a means of returning capital to shareholders. Cash is a strategic war chest, and it's dedicated solely to balance sheet repair and maintaining the acquisition growth strategy.
This leads us to the valuation puzzle. How do you value a company that is so clearly in the trough of a deep economic cycle? If we just look at the standard trailing 12 months or TTM metrics, the stock looks incredibly expensive.
Prohibitively expensive. The TTM PE ratio is around 24.1x. For a cyclical industrial distributor, that multiple suggests either explosive growth or, frankly, delusion. But this is what we call the TTM trap.
Why a trap?
Because it uses the cyclically depressed 2024 earnings, which are artificially low because of that negative operating leverage we talked about.
So we have to look forward, or we have to normalize the earnings to get a real picture.
Exactly. If we look at analyst consensus, the forward PE is significantly lower. It's around 11.9x. Now, what's fascinating is that if we take the 2023 peak earnings per share of 9.76 kroner and apply it to the current share price, the resulting normalized PE is about 12.2x.
So they're almost identical, the forward-looking number and the normalized number from the last peak.
They're right on top of each other. And that alignment, that 11.9x forward PE matching the 12.2x normalized PE, that is the market saying, we believe ALLIGO is cyclical and we expect its earnings to revert almost entirely to peak levels.
The stock is cheap if you believe the recovery is coming.
Precisely. And furthermore, we have a clear private market benchmark for valuation here. Allcell, their CVC-backed competitor, acquired the Danish firm Sanestål at an enterprise value to EBITDA multiple of 7.0x.
And ALLIGO is trading where relative to that?
ALLIGO is likely trading below or very close to that 7.0x multiple on a normalized recovered cash flow basis, which suggests it's priced reasonably for a turnaround play. This isn't some highly speculative, overpriced stock. It's a cyclical bargain if the cycle actually turns.
And finally, we should just note that the forward dividend yield, based on that cut dividend, is very low, about 1.7%.
Which just confirms what we already knew. This is an aggressive growth and recovery investment, not a dividend or income play.
Okay, now let's tie all these financial and operational tensions together into a synthesis of risk. The company's risks aren't isolated. They're all connected in this precarious chain.
That's right. The top risk is external, market development and the economic situation. The sources rate this as a 5 out of 5 for probability and a 4 out of 5 for impact. ALLIGO cannot control interest rates or construction starts. Their destiny hinges entirely on the stabilization and subsequent growth of the Nordic industrial economy.
But the top internal financial risk is massive, and it lives right on their balance sheet. That's the impairment of intangible assets, specifically goodwill.
And this is rated as having a very high 5 out of 5 impact. Goodwill is what's created when you pay more for a company than the fair value of its identifiable assets. It represents the value of synergies, brand, or future growth potential. ALLIGO holds a significant amount of goodwill from years and years of M&A.
Let's use an analogy here to make this really clear for the listener.
Okay. Imagine ALLIGO is buying a house, which is an acquisition. Yeah. They pay a very high price in a booming market, which was the pre-downturn M&A spree. That premium they paid is recorded on their books as goodwill.
Okay.
Now, the housing market, which is the Nordic industrial economy, has crashed and interest rates are high. When they run their mandatory annual impairment test, they might have to admit that the value of that acquisition is no longer what they paid for it. This recognition results in a massive non-cash write-down of that goodwill.
And while it's non-cash, it still completely wipes out your statutory net income. It could potentially violate other lending covenants or just really alarm shareholders.
Exactly. If the downturn persists and their cost of capital remains high, this risk is acute. It could erase years of reported profit instantly. And this risk is tied directly back to that leverage breach. What we're looking at is a fragile negative feedback loop that binds all these issues together.
Okay, let's walk through that loop. The market downturn
Leads to falling organic sales, which triggers negative operating leverage and crushed EBITDA.
And the crushed EBITDA leads to the leverage covenant breach, the 3.1x.
Which then forces the dividend cut to conserve cash.
And if the cycle doesn't turn soon?
The high cost of debt and the low expected future earnings threaten that massive goodwill impairment on the balance sheet.
It's the single most important chain of custody to watch in the next 12 to 18 months. So what does this all mean for you, the listener? When you're analyzing ALLIGO, you really have to choose which narrative you believe is stronger. So let's lay out the two compelling, competing investment narratives, starting with the bull case.
The bull case is a high-conviction, cyclical recovery play. The core argument here is that the heavy lifting of the integration is done. That high fixed cost base is no longer a liability. It's a coiled spring waiting to be released.
We can call this the leverage flip. The same negative operating leverage that absolutely crushed their 2024 earnings will now become massive positive operating leverage as industrial volumes return.
That's the idea. Every marginal percentage point of organic growth will generate exponential profit growth compared to their competitors who have a more variable cost structure.
And the evidence for this is that Q3 2025 margin improvement to 7.2%. That's the proof that their internal cost discipline is working and the fixed costs are ready to support higher volume.
And if that economic cycle turns, that 12x normalized PE is extremely cheap.
And the ultimate safety net for the bull is that Nordstjernen anchor. The company is managed by a long-term controlling shareholder with deep pockets and a strategic mandate, which gives the company the stability and the time necessary to weather this trough and execute the deleveraging without facing any hostile interference.
That's the bull case.
Okay, now for the dark side, the bear case.
The bear case narrative argues that ALLIGO's core business is structurally impaired, that it cannot compete effectively against the financial firepower of an Ahlsell or a Verth, regardless of what the macro environment does.
So the bear case sees ALLIGO as fundamentally a leveraged roll-up.
A leveraged roll-up, yes. A company that is using debt-funded M&A to mask the fact that their core organic sales are in structural decline, hence the necessity of breaching that 3.0x leverage target in the first place. The high debt is an existential threat.
And we cannot overlook the execution risk that's been created by this new strategic pivot, this shift to non-integrated M&A. It fundamentally undermines the synergy-based logic that justified the original massive merger.
The resulting complexity and the internal competition for capital, it's just going to drain management bandwidth at the worst possible time.
And, of course, the CEO departure. That introduces significant execution risk. Who is going to manage the recovery, the deleveraging, and this complex strategic pivot all at the same time?
It creates a leadership vacuum at the worst possible moment. That's the bear case.
So if you, the listener, are watching this volatile situation unfold, what are the key metrics? What are the 5 milestones that need to go right to prove that the bull case is winning?
Okay, number one is external. Macro recovery. We need to see clear, unambiguous signs that the Nordic industrial and construction markets are stabilizing and growing. This is the non-negotiable prerequisite.
Number 2 is the single most critical internal metric, organic growth.
Yes. We need to see positive organic growth for at least 2 consecutive quarters. That's what proves the core integrated platform is healthy and that it's capable of competing.
Third, sustainable margin expansion. That adjusted EBITDA margin has to trend decisively back into the 8 to 9% range. If it just lingers at 7.2%, the positive leverage isn't kicking in fast enough, and the stock will not re-rate significantly.
Fourth is financial discipline, deleveraging. That net operational liabilities to adjusted EBITDA ratio must trend back below that 3.0x target. That will free up the balance sheet for future opportunities and signal a return to financial health.
And finally, the new CEO appointment in 2026.
That person has to bring a credible, cohesive strategy that clearly defines how they will integrate or manage the separation of the integrated core versus the non-integrated specialist acquisitions. They have to solve that internal conflict.
ALLIGO-A.B. is truly a knife-edge situation. It is a bet that the cyclical recovery will arrive quickly enough to trigger that positive operating leverage before the persistent high debt load and all the execution risks start to weigh down the balance sheet. Or, worse, force a major impairment.
The structural tension really remains the central conflict here. They are trying to be a world-class, massive, integrated distributor optimized for efficiency through scale, and simultaneously a rapid M&A holding company pursuing high-margin specialist verticals.
So we leave you with this provocative thought to consider. Can ALLIGO-A.B. truly excel at both of these conflicting strategic visions? Can the new leadership successfully manage the complex cultural and operational rift between a highly standardized, cost-efficient core and the autonomous, non-integrated specialist growth engine?
Or will the sheer managerial complexity of trying to be 2 different companies at once ultimately undermine the foundational profitability of that core Sweetle & Tools platform?
The future of ALLIGO, I think, will be written in those conflicting internal mandates. So watch the organic growth and watch the margins.
That will tell you who is winning the internal fight.